Hey there, everybody. So today I'm going to be going over a question that I got on my one of my models. Okay, so this is from one of my subscribers. Name is Siddiq. He posted up to the website, to the YouTube channel. And by the way, if you do have questions, please, I encourage you, go ahead and post right up. I'll answer them with the video. You use price to free cash flow. I'm going to paraphrase a little bit here as a valuation metric. What I understand is that free cash flow is the cash that belongs to the entire capital providers of the company, which includes debt and equity. Correct. So if I'm taking price and comparing it against their free cash flow, it's not like comparing apples with apples. Correct. And then he says, blah, blah, I think we should use price to free cash flow to equity, which makes more sense since price is the factor relevant to the stock buyer. Exactly. Okay. So now, due to my background as a Lehman equity analyst, I think I'll always look at things as an equity holder, but correct. Price to free cash flow to the firm is kind of a jarbled metric. It would be better to use price to free cash flow to equity. Totally correct on that. So, and just by the way, though, about the free cash flow measurement in general, my comment on it is that it does take into account capex, so you get a sense of what it's really costing the company to make the most of its assets. However, you got to keep in mind that management can manipulate this. It's very subject to accounting trickery. For example, they can stretch out payment time frames, and this is something that companies do, and it throws off the street a little bit, and unless you're aware of it and you look at it with that very discerning eye. So I do like free cash flow a lot more than EBITDA though. But just in general with ratios, you do have to keep in mind, are these two companies in the same industry or different? What time frame is it over? The longer is obviously the better, more data points available. And so what I don't like about the free cash flow to equity and also even free cash flow to the firm is that, like I said, they're very affected by different accounting methods. So for example, one ratio that I like a lot is the dividend yield, which is the dividend over the price, dividend per share over price per share. And the reason is that it shows price relative to dividends, and they're both as stated without calculation involved. So it's a lot less able to be manipulated because it's more tangible. Like it's not like you're taking into account, like with EBITDA when you're adding back the interest and the taxes, and like companies can have tons of debt, and with EBITDA, two companies, are going to look if they have the same EBITDA, they're going to look the same, whereas one could have tons of debt, the other one might not. That debt's definitely coming due, but their EBITDA looks the same. So, just with dividend yield, I think that's one that I like to look at a lot, by the way, and as opposed to any of the free cash flow valuation metrics in general. Hey, thanks everybody for tuning in. And as I said, go ahead and please post up any questions you might have to my YouTube. We'll be glad to answer you.